Well, if you've been following the stock market for the past couple weeks, you've probably been pretty bored because not much has been going on. The S&P, of course, has made record highs over 3,000, and it seems to have been maintaining that level here for the last few days. So you would think that there would be a lot of optimism and euphoria on the floor, and that you would have lots of folks celebrating in the press, but really you haven't heard much about the S&P being over 3,000, which is, of course, psychologically a huge milestone. But interestingly enough, you're not hearing that same sort of naked euphoria that you typically would when stocks are at all-time highs. I'm actually happy to say that there seems to be a bit more skepticism in the air than there has been in the past when stocks have hit all-time highs. Now, perhaps that's just me being optimistic, but I think I tend to be pretty pessimistic, so if I'm seeing a bright side when it comes to the sanity of folks involved in the stock market, well then perhaps there really is something to that. I think implicitly, even if folks aren't willing to say it, they understand that people like me are right when we say that your new all-time highs have nothing to do with the real economy. And in fact, the only reason why the stock market was able to make new all-time highs after the 2008 crash has been because of really just Fed stimulus. The Fed has essentially been, since 2008, printing money and dumping it into the stock market to drive up stock prices. And then the Fed wonders why we don't see any consumer price inflation. Well, it's because consumers, ordinary people, aren't seeing any of this money that the Fed is printing. The Fed is essentially printing money and injecting it into the portfolios of your top 1% folks. And I'm not a Bernie Sanders type hate the one percenters, but I have to call balls and strikes here, and it's pretty clear what the Fed is doing. Bernanke said as much after the crisis that essentially they're going to try and push up the stock market to get the wealth effect to increase consumer confidence. And that's what they did, because when people turn on the TV and they see stocks are at all-time highs, ordinary consumers, even if they don't own any stocks, they say, well, the economy must be doing pretty well, and that makes them feel like it's okay to spend a little more money and not be as frugal or as responsible with their money. Now, a sane person would say that encouraging people to be irresponsible with their money by manipulating stock prices to boost them up to unsustainable levels, some folks would say that that's a terrible thing. But again, in the twisted Keynesian logic of mainstream thought, that's perfectly reasonable, and in fact, it is desirable. But now we've really reached the end of the road, where the Fed keeping rates where they were really hasn't produced any real growth, and so therefore when the Fed started raising rates last year, really in earnest, the stock market started to feel the heat, and they realized that they really didn't have anything else going for them other than 0% interest rates, because the real economy hasn't grown much over the last 10 years. And certainly the real economy hasn't grown enough to justify these high stock prices. All you have to do is look at a graph of U.S. GDP versus a graph of the S&P 500, and you see that they don't exactly track even. The S&P has been growing much faster. The S&P has, on average, double-digit growth every year since 2008, and the economy, the real economy, has been growing in the low single digits. Under 3%. And so we're really standing over a cliff, because everyone is kind of like in the stock market right now. It feels kind of like Wile E. Coyote when he goes over the cliff, and he hasn't realized quite that he's over dead air, and that there's no longer any ground under him, until suddenly he looks down and he notices, oh God, the floor is gone, and then he falls all the way down to the bottom. That's where folks are right now in the stock market, and they want the Fed to come there and start pumping air under them to try and lift their sails a bit, to try and give them a soft landing. And in fact, they want more than that. They want something that is impossible, and they want the Fed to somehow pump enough air under them to keep them levitating in perpetuity, and in fact push them higher. And in fact, it's only the optimism that the Fed will cut rates that has allowed asset prices to remain as high as they are even to today, because in the last couple months, the credit markets have had to price in a rate cut from the Fed just in order to maintain their current levels and to keep the party going. So that means if the Fed really wants to cut rates and stimulate the economy more than they already are, not only do they have to cut that 25 basis points, because again, if they don't cut, the market's already priced in a 25 basis point cut. So if the Fed doesn't cut rates, well then the market will have to then reprice that in, and you're going to see a sell-off in the markets, because the credit market is already looser. It's assuming that the Fed is going to cut rates. So therefore, if the Fed wants to actually overtly stimulate the economy and give the economy more juice than it's expecting in terms of that monetary heroin, it's going to have to cut 50 basis points. And that's what you're seeing all of the Fed doves come out and say in recent days. Of course, Bullard and Kashkari chief among them. But of course, when you've only got 225 basis points or 250 basis points, 50 basis points is a big, big cut. That's 0.5% out of 2.25 or 2.5% interest. So that means that pretty soon, because I have to imagine if past is any precedent, if past performance is at all indicative of future results, this 50 basis point cut will not be the last one. That will not satisfy the markets, because the markets need ever more stimulus in order to keep their highs. I mean, they are quite literally like a heroin addict. They need a bigger and bigger doses because they've built up a resistance. So pretty soon here we'll be back at 0%, and from there the only options that the Fed has left either are going negative interest rates, just like the rest of the world, or I should say like Europe and Japan, or going back to QE, or both. So it looks like, at least to me, that quantitative easing is on its way. And when they did quantitative easing, there was some interesting folks who came up with what they called the shadow Fed funds rate, and they tried to price in the value of QE into the credit markets, and then that essentially pushed the Fed funds rate into the negative territory, even though officially it was 0%. I'm not so sure about the methodology of that study, if it's really valid to say that QE pushed rates negative, but it certainly loosened financial conditions more than just having 0% interest rates on their own. Now, I wouldn't be shocked, frankly, if we see a return to QE before the 2020 election, and I'm certain that the president will be begging for a return to quantitative easing for the start of QE4 long before the election actually takes place next November. You know, somebody was passing around a clip a couple days ago of Trump from 2016 in which he said essentially that the Fed blew a great big asset bubble, and that was going to pop, and that we had this fake economy. And I'd known that Trump had said something to this effect in 2016, but I was astounded by how spot on he was and how wrong and I guess just dishonest he is now for claiming that this economy is somehow of his making. It seemed to me that Trump knows exactly how awful and in what dire straits this economy is in, and that's why he's going to beg for more stimulus, because that's all that's holding the house up at this point. And I think, frankly, at this point that the Fed knows they're going to have to cut 50 basis points no matter what. Perhaps if stocks are doing particularly well on the day of the Fed meeting, they'll only cut 25 basis points, but I really think that they'll come to regret that. And if you look at every other tightening cycle, in this century, Greenspan and then Bernanke both started with 50 basis point cuts. And so definitely I would say here's my hard call I'll make. If the S&P is below 3,000, which it likely will be because on the day that the Fed meets, because they're bumping into overhead resistance at the moment, so you might see a bit of a sell-off. And of course there's that broadening wedge that Sven Henrik has been citing. I don't have time to get into that. But I would say if the S&P is below 3,000, you see a definite 50 basis point cut. And even if it's above 3,000, I think you'll see a high probability of a 50 basis point rate cut because the pressure's just been mounting, and I don't think Powell can bar the door any longer. The doves have taken over, and Powell was always a dove himself, as far as I'm concerned. So if you gained anything of value out of this video, I'd appreciate you clicking that like button and subscribing. And if you do subscribe, please do click the bell because I do upload every day, and I'd hate to have you miss one. So I'll see you folks back here tomorrow.